The silence before the storm. That's what trading feels like when you're about to discover something that changes everything. You sit there, staring at red numbers on your screen, wondering where it all went wrong. Like this video and subscribe to the channel. Your engagement is crucial for the future of our channel. Maybe you've been there too. Months of studying, analyzing charts until your eyes burn, perfecting what you thought was the perfect approach. The wins felt incredible. Pure adrenaline coursing through your veins as profits climbed. But then came the losses, one after another, like dominoes falling in slow motion. The market seemed to turn its back on you, no matter how hard you fought. You blamed your emotions, fear, greed, impatience. Surely these were the culprits sabotaging your trades. So you meditated, journaled, tried every mental trick imaginable. Yet, the losses continued. Here's the brutal truth. It wasn't your emotions destroying your account. It wasn't lack of discipline or the wrong mindset. The real problem cuts much deeper. You've been trading without a genuine edge, trying to win a game whose rules you never truly understood. This revelation might sting, especially after countless hours grinding away, hoping the next trade would turn everything around. But what if success isn't about working harder or controlling emotions? What if it's about something far more fundamental? Building a strategy that actually gives you a statistical advantage. Today, we're stripping away the myths and focusing on what truly separates successful traders from the rest. Clarity, data, and systematic thinking that works regardless of market conditions. Imagine trying to win a game you don't understand. No matter how hard you try to focus or control yourself, that's exactly what trading without an edge feels like. Here's the harsh reality. You can follow all the rules, manage risk perfectly, and still lose. Why? Because your setup has no positive expectation. Your trades are built on guesswork, not data. You might get lucky in the short term, but in the long run, the lack of a real edge will drain your resources completely. The odds are fundamentally against you, and this is precisely why over 80% of day traders quit within the first 2 years. It's not because they lack discipline or drive, it's because they're attempting to push a car uphill without an engine. They've invested years perfecting a system that was never designed to win in the first place. But this isn't a story of hopelessness. It's a wake-up call. Because the moment you recognize that the problem isn't you, but the system you're using, everything transforms. The emotional struggle becomes less about self-control and more about accepting that. Without a statistically sound system, you're fighting an impossible battle. And when you shift your focus from controlling your emotions to creating an edge, everything starts to align. This emotional roller coaster isn't just a trader's challenge. It's the struggle of anyone who has tried to succeed without the right tools. The difference between success and failure in trading isn't about emotional strength. It's about understanding market dynamics and designing a strategy with a genuine advantage. Once you stop viewing your emotions as the enemy and start addressing the core issue, the lack of a statistical edge, only then will you achieve sustainable success. So when you feel that emotional pull during a trade, instead of criticizing yourself for emotional weakness, ask one crucial question. Does my strategy truly have an edge? That's where the real journey begins. Recognizing that the path to success isn't through emotional control, but by building a consistently effective system. Imagine you're standing at the edge of a cliff, looking out over a vast ocean of potential trades. Trading is like surfing, with some riders gliding effortlessly, while others struggle to stay above water. The key difference lies in their approach. Skilled traders, like seasoned surfers, have a system. They understand market dynamics, know precisely when to act and when to hold back. In contrast, less experienced traders are essentially hoping for luck, randomly attempting to catch waves and praying the market will be merciful. In trading, just like surfing, you need a genuine strategic advantage. This isn't about lucky guesses or believing in magical chart patterns. A real edge is statistical, grounded in concrete data, mathematically measurable, and consistently repeatable. Without such an edge, trading becomes pure gambling. You're essentially wishing the universe will favor you, but markets are indifferent to emotions and never reward mere hope. The edge formula is straightforward. Edge equals win rate multiplied by average win minus loss rate multiplied by average loss. This sounds simple, but most traders misunderstand its nuances, overemphasizing win percentages while neglecting loss management. Consider two traders. Trader A appears successful, winning 80% of trades. However, her average win is 100, while her average loss is $500. When we calculate her edge, the math reveals a different story. 0.8x $100 minus 0.2x $500 equals $80 minus $100, resulting in a net loss of $20 per trade. Despite frequent wins, Trader A is actually losing money. Conversely, Trader B wins only 40% of trades, seemingly a poor performance. Yet her average win is $300, with an average loss of $100. Calculating her edge shows 0.4 is $300 minus 0.6 equal $100 equals $120 minus $60, resulting in a $60 profit per trade. She's making money despite losing more often than winning. This demonstrates that high win rates don't guarantee profitability. What matters is the relationship between wins and losses, carefully managed through a robust, data-driven strategy. She's experiencing more losses than victories. However, her larger average win sizes mean she's still generating profit. This demonstrates the true power of a genuine trading advantage. Success isn't about winning every single time, but about developing a system that generates money over extended periods, even with more losses than wins. The critical focus should be on mathematical principles, ratios, averages, win rates, and most crucially, risk-reward calculations. Most traders become fixated on achieving a high win percentage because winning feels psychologically satisfying. They mistakenly believe more wins indicate a superior trading system. The real insight lies deeper in the mathematics. A true edge means recovering more during winning trades than you surrender during losing ones. Calculating your edge requires more than remembering recent trades or feeling confident. It demands comprehensive tracking of every single trade, both successful and unsuccessful, and maintaining brutal honesty about your performance metrics. Many traders remain unaware of their actual edge because they selectively remember victories while conveniently forgetting defeats. Serious traders must meticulously document results, starting with precise numerical analysis. The challenge is straightforward. Examine your last 30 trades, determine your win rate, calculate average win and loss amounts, then apply the appropriate formula. The resulting number reveals whether you possess a genuine trading advantage or need strategic recalibration. Understanding your edge represents merely the initial step. Once you comprehend the numbers, you can systematically refine your approach, experiment with new techniques, and make data-driven adjustments rather than emotion-based decisions. The goal isn't hoping the market cooperates, but constructing a consistently advantageous system capable of performing under varied market conditions. The fundamental question remains: do you truly understand your trading edge, or are you simply operating on wishful thinking and emotional impulses? The distinction between gambling and trading lies in understanding the numbers. Without knowledge, you're merely gambling. With it, you're constructing a system for success. Now that the significance of a measurable edge is clear, it's time to explore how to actually develop one. This is where the true transformation occurs, taking a theoretical strategy and converting it into a consistently profitable approach. Building a genuine edge isn't an overnight process or a quick solution. It's not about chasing the latest indicator or strategy, promising instant success. Instead, it's a methodical journey of careful observation, testing, and refinement. The goal is to transform trading from an art into a science, understanding precisely what works, what fails, and why. Let's explore 3 powerful techniques successful traders use to gain a statistical advantage: pattern hunting, edge engineering, and success reverse engineering. To apply these effectively, you must first have a crystal clear understanding of what you're seeking. Pattern hunting involves market observation and identifying repeatable behaviors. Imagine being an archaeological researcher, excavating hidden patterns within market noise. This goes beyond memorizing candlestick formations or relying on simple chart patterns. The focus is on discovering subtle, statistically significant patterns that consistently emerge. These patterns might reveal how markets react after specific news releases or how certain assets respond to economic data. For instance, you might observe that when oil prices drop more than 5% in a single day, airline stocks rise 65% of the time the following morning. Crucially, this insight comes from personal observation, recording, and testing, not from a textbook. The critical point is not finding patterns that merely feel right, but rigorously testing them. You must track observations and build a comprehensive database, demonstrating not just where patterns appear, but their frequency and reliability. This is where the genuine work begins, transforming intuition into verifiable strategy. The most skilled traders don't simply make random guesses. They meticulously track, test, and continuously refine their approach. Their goal is transforming observations into a consistent, reliable process. The next critical phase involves engineering a personal trading edge by actively developing market hypotheses. A trader might wonder, for instance, whether stocks that gap up 4% after earnings with above-average volume tend to continue rising 70% of the time. The key is creating a hypothesis, systematically gathering data, and then rigorously testing it. Successful traders never rely on gut feelings or base decisions on a few isolated successful trades. Their entire strategy is anchored in hard data. In fact, data accumulation progressively clarifies and sharpens their trading edge. This methodology closely resembles a scientific experiment, where different variables are systematically tested, data is collected, and results are carefully analyzed. Over time, patterns emerge. A hypothesis might prove valid 68% of the time, but only under specific conditions like high trading volume or a particular news event. This level of precision allows traders to construct a dependable strategy. It's crucial to understand that perfection isn't the goal. A 60% success rate can be remarkably profitable when combined with disciplined risk management. Reverse engineering market success involves forensically analyzing massive market movements. Traders dissect significant rallies, investigating the preceding conditions. What triggered a 500% stock surge? Was it a volume spike, a specific catalyst, or a sector-wide behavioral shift? The objective isn't capturing the move as it happens, but understanding the underlying mechanics and recognizing potential future opportunities. By identifying common characteristics of major market movements, traders can develop frameworks for anticipating setups. For example, a trader might observe that every significant short squeeze shared 4 key traits: low float, high short interest, a compelling catalyst, and a sudden volume explosion. Recognizing these shared attributes allows strategic preparation for similar future scenarios. Regardless of the specific approach, one principle remains universal: meticulous documentation. The market is a trader's laboratory, demanding rigorous observation, analysis, and continuous learning. Every trade, every pattern, every observation is part of the scientific method. You're not just gambling. You're hypothesizing, testing, and analyzing. You're turning your trading into a process that works over time. Here's the crucial takeaway. Once you've identified a repeatable edge, you stop trading on hope and start trading on certainty. You know what works, you know why it works, and you've proven it with data. The fear of failure starts to disappear because you know that even if you lose a few trades, your edge will carry you through over the long run. But here's the real kicker. Knowing your edge is only the beginning. Now you need to embody it. What does that mean? It means that your edge is no longer something you just follow. It's something you live. You become so confident in your edge that it starts to feel like second nature. Your system becomes an extension of your thinking. You don't second guess it. You don't doubt it. You trust it because it's been tested and proven. Now that you have a clear understanding of how to build a real edge, we need to shift our focus to a crucial component of trading that many traders overlook: the exit strategy. It's easy to get caught up in the excitement of entering a trade, the rush of seeing your analysis come together, the joy of hitting your entry point perfectly. These are the moments that traders often focus on. But what happens after you've entered the trade? This is where the real magic happens, or the real downfall. Your entry got you into the trade, but it's your exit strategy that determines whether you will truly profit. This is the piece of the puzzle that many traders get wrong, often obsessing over the perfect entry while neglecting to fine-tune their exit strategies. This is a mistake that can cost you your profits, especially when the market turns unexpectedly. Here's the truth. Perfect entries with poor exits lose money. Average entries with excellent exits make money. The entry gets you into the game, but the exit determines how much you win. Think about it. Two traders enter the same stock at the same time, at the same price, with the same setup. A trader can exit at a 1R profit, while another exits with a 3R profit. And the key difference lies in the exit strategy. Let me illustrate this with an example. A momentum trader conducted an experiment with 3 different exit strategies on the same setup across 100 trades. The first approach was a fixed target exit, where a specific target like 2R is set, and the trade is closed once that level is reached. After 100 trades, this strategy yielded a 45% win rate, with an expectancy of 1.35R per trade. The second method involved a trailing stop exit, where the trader uses a trailing stop at the previous bar's low. This strategy resulted in a 38% win rate, but produced an expectancy of 1.52R per trade, slightly outperforming the fixed target approach. The third strategy was a hybrid approach, where the trader scales out of the position by selling half at a 1R profit and trailing the remaining portion. This method generated a 52% win rate with an expectancy of 1.61R per trade, proving to be the most profitable technique. The lesson is straightforward. The right exit strategy can significantly enhance your trading edge. Using a different exit strategy with the same entry can dramatically alter the trade's outcome. This is why successful traders invest as much, if not more, thought into their exits as they do into their entries. The market's dynamic nature means that a perfect entry point can quickly become irrelevant as price action evolves. Maximizing profits hinges on knowing precisely when to exit a trade, whether at a profit or a loss. The ability to exit at the right moment before the market reverses or fades distinguishes professional traders from amateurs. Many traders fall into the trap of holding positions too long, driven by hope that prices will continue moving in their favor. This often leads to profit erosion, or worse, transforming a winning trade into a losing one. Psychological factors play a significant role here. Traders may fear missing potential profits or develop an emotional attachment to a trade, clinging to the belief it will turn around despite clear contrary evidence. To overcome these psychological pitfalls, it's crucial to establish exit rules before entering a trade. Planning your exit strategy is crucial before entering a trade. You need to determine whether you'll take profits at a specific level, use a trailing stop, or exit at a predetermined time based on your trading approach and market dynamics. Experienced traders emphasize establishing exit rules before executing a trade, which helps eliminate emotional decision-making that typically results in poor exit choices. The market remains indifferent to your feelings and only responds to the rules you establish and your adherence to them. To refine your exit strategy, try an experimental approach. Select your current trading method and test 5 different exit techniques across 50 trades. Maintain consistent entry criteria while varying exit methods. Monitor not just your financial results, but also the emotional challenge of implementing each exit. Some exit strategies might appear mathematically optimal, but could be psychologically challenging for certain traders. The ultimate goal is discovering the sweet spot where profitability intersects with psychological comfort, which is essential for sustained trading success. Scaled exits represent an advanced technique involving exiting trade positions at multiple stages. By dividing your position, you can strategically manage risk and potential profits. The first portion might be sold to reduce exposure, the second to capture the expected market movement, and the third to potentially capitalize on unexpected large market swings. This multi-stage approach offers significant advantages by adapting to market behavior. When markets move favorably, you can maximize profits by allowing portions of the trade to continue running. Conversely, if markets turn unfavorable, you've already mitigated risk by partially exiting your position. The fundamental lesson is straightforward. Exit strategies are equally, if not more, important than entry strategies. Recognizing this shifts focus from obsessively seeking perfect trade setups to effectively managing ongoing trades. Systematizing your trading becomes the critical next step in elevating your approach. The most successful traders don't spend hours glued to screens, frantically reacting to every market fluctuation. Instead, they develop intelligent systems that make decisions autonomously, scanning markets for valid setups and executing trades based on precise, predefined rules rather than emotional impulses. The first crucial element in this process is absolute clarity. Your trading strategy must be so straightforward that you can explain its entire essence in a single, crisp sentence. If you cannot do this, your strategy needs serious refinement. Consider a concrete example. Buying stocks that gap up over 4% following earnings reports, with double the average trading volume, and holding those positions if they remain above VBWAP for a minimum of 15 minutes. This type of clear, specific description demonstrates the level of precision required. The second fundamental aspect is establishing unambiguous conditions. Every single component of your strategy must be governed by measurable, testable, and executable rules that leave no room for interpretation or emotional interference. This means defining exact parameters with surgical precision. What precisely constitutes a 4% gap? Does this mean at market open, or does the stock need to sustain that gap? What specific volume threshold defines double average? These conditions must be non-negotiable, applied consistently regardless of your emotional state or excitement about a potential trade setup. By developing such a systematic approach, you transform trading from a reactive, emotion-driven activity into a disciplined, methodical process. Your system becomes an objective mechanism for identifying and executing opportunities, removing human inconsistency from the equation. After establishing your strategy and defining your conditions, the next step is automation. This phase allows the system to handle the complex work. Modern trading platforms offer sophisticated automated filters capable of scanning thousands of stocks simultaneously. Instead of manually searching for potential setups, you can configure software to filter stocks matching your specific criteria. When a stock meets your predefined conditions, automated alerts will notify you about the potential opportunity. Automation extends beyond identifying setups. It's crucial for risk management, which should be integrated into your system from the start. Without proper risk management, even the most promising trade could result in significant losses. Implementing automatic stop losses, take profit levels, and position sizing algorithms becomes essential. For instance, you might create rules like reducing your position size by 20% after a winning streak of 5 consecutive trades, or automatically stopping trading if daily losses exceed 2% of your account. These automated rules execute independently of your emotional state, which is the primary advantage of systematizing trading. They remove the potential for impulsive, emotion-driven decisions that often lead to costly mistakes. The system operates consistently, regardless of your momentary feelings or market pressures. However, establishing the system is just the beginning. Continuous tracking and data collection are vital. Each trade provides an opportunity to gather information. Did the trade align with your initial conditions? Did it adhere to your established rules? How effective was your exit strategy? What was your emotional experience during the trade? By meticulously analyzing this data, you can progressively refine your approach. You'll gain insights into what strategies work, which need adjustment, and develop a more robust trading methodology. One trader described this transformation, noting how his systematized approach transformed his trading experience from mentally exhausting to a controlled, supervised process. My results improved by 40% because I was executing a system, not just relying on my gut feelings. This is the power of systematizing your trading. It allows you to focus on the high-value decisions, like managing your portfolio and adjusting to changing market conditions without getting bogged down by minute-to-minute reactions. As you start to systematize your trading, your role as a trader will shift. You will go from being reactive to proactive. You will no longer be chasing the market or scrambling to find the next trade. Instead, you will be managing a process that consistently finds profitable setups and executes your strategy. The mental energy that once went into second-guessing and hoping will now be used for higher-level decision-making. Is this the right market condition for my strategy? Does this trade align with my current edge? The ultimate goal is to build a trading machine that works for you, a system that executes trades according to a clear set of rules, without emotion, without hesitation. And as your system gets better over time, your confidence will grow. You will not be relying on hope or luck anymore. You will be relying on a well-oiled system that works over and over again because it is based on proven principles. As you sit back and reflect on what we have covered today, let me ask you this. What would your trading look like if you stopped trading on hope and started trading on a system? Imagine waking up every day with complete clarity, knowing that your strategy has been tested, refined, and proven to work. No more second guessing, no more emotional roller coasters. Instead, you're operating from a place of confidence and precision, executing your trades with the knowledge that you are in control. The truth is, the markets are ruthless. They will test you, push you to your limits, and at times break you down. But it is not about surviving those moments. It is about thriving through them. And thriving comes from one thing: having a real edge, a system that you trust that works for you, not against you. So as we wrap up today, take a moment to think about where you are in your trading journey. Are you still relying on luck, or are you ready to build a real edge that works consistently? The decision is yours. You can either keep pushing that car uphill, hoping it will one day start moving, or you can get in the driver's seat, build the engine, and finally take control of the road ahead. I want to leave you with one thought. Building an edge does not happen overnight, but every step you take towards systematizing your trades, refining your strategy, and understanding the numbers is a step toward lasting success. Do not let the markets break you. Let them show you what is possible when you finally get it right. The real edge is not in the charts, it is in you. So take that first step today and start building it. If you found this video helpful, subscribe and share your story in the comments. Your support helps others too.